What's up, investors? It's the Russian dude. In today's short video, let's talk about the fundamental flaw that a lot of stock market experts and definitely stock market participants do, which allows them to make a lot of mistakes and which prevents them from making more money than they should. And this flaw is called the emotional involvement and irrational behavior. Whenever those stock market experts, especially the ones who do believe in the technical analysis, whenever they do make their investment decisions based on looking at the previous past performance on the graphs going up and down, building support and resistance levels, they rely this information, they picture this information based on the fact in their heads that the stock market is rational, which is almost never the case. The stock market is fully, completely, impossibly irrational. Because if everything would make sense, if the patterns would repeat themselves, every single decent trader with a basic knowledge of the technical analysis will be able to make billions out of just trading stocks. Yet, we see just a single-digit number of successful traders. For example, the very easiest explanation and the very easiest example of the very same phenomena but from regular life is, for example, whenever you are shopping for some, I don't know, apple juice or orange juice, and you as an irrational person, you either just take a familiar brand or something that might be on discount or something that just simpler to reach, or maybe even the brand logo is very attractive. You don't make a rational decision of investigating the entire orange juice market, driving to neighboring cities, towns and different Walmarts and your local grocery stores just to compare where is the cheapest orange juice, the freshest one, what's the volume of these boxes, because this is what a technically quote-unquote rational shopper will do. He will compare everything just to get himself the best deal possible. And this is exactly how the majority of stock market participants think the stock market works. They think that every single other market participant follows almost exactly the same rules, that they do an extensive research, they read the analysis, they read the financial reports of different companies before investing in one single one. They compare hundreds of companies from the same industries before making their investment decision. And yes, there are obviously people like this, professional investors and stock market enthusiasts, but in its majority, a lot of market participants are just either investing in ETFs, stock market funds, like REITs, these kind of things, mutual funds, or just simply because they like the way a company sounds, or maybe this is a company that they personally use, like for example Apple, Google, Microsoft or Amazon. So basically what I'm trying to say here is that not every stock market participant would do an extensive research before making his decision to invest in a single company. Because let's think about this. Yes, most likely there is a perfect company, at least one of them in each particular industry, and if every single person will be doing this extensive level of research, eventually they all will come to the very same conclusion that this is the company where they should invest. So this company will continuously grow, while the rest of the companies from the same industry, well, nobody will be buying them. Yet, we don't see that this situation happens. Another example of the stock market being extremely irrational is the people who just buy companies because everyone talks about them, because these are the companies you always hear on the media, and once again these could be the companies that you personally use. That is why companies, once again, like Apple, Microsoft, Amazon, Tesla, Nvidia are one of the most popular ones, and they have the biggest trading volumes in comparison to other companies. The next example of market irrationality is so-called confirmation basis. This is also can be described as whenever you do like a stock or a particular company, you will always try to focus just on the good news. You will try to find the news which support your love for this company. And obviously you cannot be attached to a single stock on the stock market if you want to be a successful investor, because even if the news are really bad and you will just still try to hold on to a single sentence in the several pages report that shows that yes, something is good or promising, well, you might be blinded by the love to this company. As a result, you will be making, guess what? Irrational decisions. Another market irrationality which we talked about in the beginning of this video is that a lot of market participants, especially beginner ones, they rely on the past example and they build their future strategy based on these past results. They see that the stock was continuously going up and they think that, well, the company will keep going up. They see that the company dropped significantly, like 70-80%. They think, well, now is the very bottom of the stock price. I buy it right now. It will inevitably go up, which sometimes might not also be the case, because there is a reason why a stock declined 80%. And then yet another market irrationality example is whenever people they just chase lucky stories. They heard about a guy who invested in Tesla back like 15 years ago. He invested $1,000. Now he is almost a millionaire. He has so much money, so they want to replicate this guy's success. So they start looking extensively just for next Teslas, overlooking other particularly pretty good investments, and as a result majority of them they do lose money, because for every one single person who did make a lot of money on the stock market just by investing in a single company, there are 99 other people who invested in a perfect, as they thought, company, and they lost a lot of money. And as a result, right here you can see the biggest problem, the biggest flaw of the stock market participants, and obviously also even stock market experts. They base a lot of their investment decisions based on these models which think that the stock market is rational. They think that market participants, they make their fundamentally researched decisions, that they don't just invest randomly in companies. Once again, yes, there are people who do extensive research before putting even $100, but billions of dollars on the US stock market are invested just because. And this is the fundamental flaw that so many people overlook. Well, there you have it, guys. Thank you so much for watching. Please like this video and subscribe to my channel if this was interesting, informative or both, and see you on Monday.